Imagine waking up one morning, checking the financial news, and reading this headline. The dollar just had its worst quarter in 30 years. Not a prediction, not a theory. Something that already happened in the first 3 months of 2026. This is not a story about the future. This is a story happening right now. And today we are going to break down exactly which countries are quietly moving away from the US dollar, what the hard data says in April 2026, and what it means for your money. To understand why this matters so much, we need a quick history lesson, because the dollar did not become king by accident. After World War II, in 1944, world leaders gathered in Bretton Woods, New Hampshire, and made a formal decision that changed everything. The US dollar would be the world's reserve currency. Then, in 1974, the US and Saudi Arabia struck a deal that reinforced that crown permanently. Oil, the single most important commodity on Earth, would be priced and traded exclusively in US dollars. This became known as the petrodollar system. Every country that needed oil also needed dollars. That was basically every country on Earth. At its absolute peak, the dollar represented over 70% of global foreign exchange reserves. It was used in 96% of trade invoicing across the Americas, 74% across Asia, and 79% in the rest of the world. The dollar was not just a currency, it was the architecture of the entire global economy. Here are the numbers that should be on every investor's radar right now. According to the latest IMF COFER data, the dollar's share of allocated global reserves fell to approximately 56.1% in the first quarter of 2026, a 2.3 percentage point decline in a single quarter. The dollar typically loses that much reserve share over 2 to 3 years. It lost it in 3 months. The total value of dollar-denominated reserves declined by approximately $340 billion, even as total global reserves actually increased by $180 billion. That means central banks were not just passively reducing dollar exposure, they were actively selling dollars and buying alternatives. On the SWIFT payments network, the dollar's share of international payments declined from 47.5% in December 2025 to 43.8% in March 2026. A 3.7 percentage point drop in a single quarter, the largest quarterly decline in SWIFT's reporting history. Meanwhile, the UN's share of SWIFT payments increased from 4.7% to 6.2% over the same period. So what is driving this? 3 forces, all happening simultaneously. The first, the weaponization of the dollar. The second, America's own economic vulnerabilities. The third, the rise of credible alternatives. Let's go through each one. For decades, the United States has used financial access as a geopolitical tool. Sanctions, asset freezes, exclusion from the SWIFT banking network. This reached a turning point in 2022 when Russia was cut off from SWIFT almost overnight. Watching that happen, countries around the world had the same thought. If it happened to Russia, it could happen to us. That realization changed the conversation permanently. America's own economic vulnerabilities are adding to the pressure. U.S. government debt now exceeds 100% of GDP. Global markets outperformed U.S. stocks by nearly 2 to 1 in 2025, with record flows into emerging markets. When the safest market in the world starts to look less safe, the currency anchored to it loses some of its appeal. The third force is the rise of credible alternatives. Not one single replacement, but a network of options that did not exist before. Digital payment systems, bilateral currency agreements, gold, and central bank digital currencies are collectively building what many economists now call a parallel financial highway. Now let's go country by country. Let's start with Russia, because Russia is the most extreme case. When Western sanctions removed Russia from SWIFT in 2022, Moscow was forced to rebuild its entire financial architecture almost overnight. Today, Russia and China settle between 90 and 99% of their bilateral trade in their own currencies, yuan and rubles, with no dollars involved at all. China is the architect of everything happening globally. In early 2026, state-linked Chinese banks accelerated sales of U.S. treasuries, pivoting toward gold, yuan infrastructure, and alternative financial systems. China's cross-border interbank payment system, CPS, now handles a daily average of 9.6 trillion yuan in transactions, with annual growth exceeding 65%. China has signed bilateral currency swap agreements with over 40 central banks worldwide. Saudi Arabia, the original pillar of the petrodollar, is quietly repositioning. In June 2024, Saudi Arabia chose not to formally renew its exclusive commitment to dollar-priced oil. And it signed a $7 billion currency swap with China and joined the Enbridge digital payment platform, which processed over $55 billion in transactions by November 2025. And in 2026, ships passing through the Strait of Hormuz are making payments in Chinese yuan, what analysts call the first operational petro-yuan corridor in history. India is playing its own careful strategic game. India has set up local currency settlement agreements with at least 7 nations and special rupee-based trade accounts with at least 26 countries. India and the UAE now settle oil transactions in rupees and dirhams, bypassing the dollar entirely. And gold now makes up 14% of India's foreign exchange reserves, compared to just 9% the previous year. But India is being diplomatically careful. And India's foreign minister stated that India has no official policy to replace the dollar. India is de-dollarizing strategically, diversifying without making enemies, keeping its options open in all directions. Across Asia, the movement has become structural. ASEAN formally committed in its new plan for 2026 to 2030 to promoting local currency settlements in all trade and investment. And in 2025, 97% of trade among the Shanghai Cooperation Organization nations, a bloc that includes China, India, Russia, Iran, Pakistan, and others, was conducted in local currencies. Not in US dollars, not in euros, local currencies only. Brazil, too, has been shifting its reserve composition steadily. Brazil's dollar share of reserves has fallen from over 80% a decade ago to under 60% today. Brazil and China conduct significant bilateral trade in reais and yuan directly, and Brazil's digital payment system, PIX, is being explored as a foundational layer for BRICS-wide payment integration. Now here is the piece of the story that most mainstream media almost completely ignores, and it may be the most important part. The real replacement for the dollar is not another currency. It is gold. The World Gold Council reports that central banks purchased 420 tons of gold in just the first quarter of 2026 alone, shattering the previous quarterly record. Global central bank gold purchases are on track to exceed 1,600 tons for the full year of 2026, more than double the average annual purchases of 2015 to 2020, and roughly 40% of total global mine production. Central banks are buying 40% of everything the world mines in gold every single year, on top of what is already in their vaults. Gold prices rose 60 to 70% in 2025, pushing prices well above $4,000 per ounce for the first time in history. In early 2026, prices continued rising, hitting over $5,500 per ounce. Goldman Sachs has set a target of nearly $5,400 by late 2026. JP Morgan forecasts an average of around $5,055. Meanwhile, the alternative payment infrastructure is being built in parallel. BRICS Pay announced plans to launch operationally in 2026. The system integrates Brazil's PIX, Russia's SPFS, China's CIPS, and India's UPI into a single interconnected network. The BRICS Cross-Border Payment Initiative is now processing an estimated $180 billion in monthly transactions, operating entirely outside the SWIFT network. Now, and this is critical, let us be completely honest about where things actually stand. The dollar is not dying. Anyone telling you the dollar collapses next year is selling you something. The dollar still appears in nearly 9 out of every 10 foreign exchange trades globally. The U.S. Treasury market at approximately $30 trillion remains the deepest and most liquid in the world. Currencies dominate because markets cannot function without them, and switching the entire global system would be like trying to move everyone off email in a single day. What is happening, and this is the precise, accurate, honest description, is fragmentation. The world is not replacing the dollar. It is building insurance against the dollar. countries are not trying to kill the dollar. They are trying to reduce their dependence on it. Think of it like someone who keeps one phone as their main device but buys a backup from a different brand, just in case. So what does all of this mean for you, sitting here in April 2026? First takeaway, the pace has changed. This is no longer a slow, theoretical drift. A 2.3 percentage point drop in dollar reserve share in a single quarter. A 3.7 percentage point drop in SWIFT dollar payments in 3 months. These are historically unprecedented speeds of change. The direction has been consistent for 25 years, but the speed is now accelerating. Second takeaway, gold is not a speculative bet anymore. It is official central bank policy across 43% of the world's reserve institutions. When the most conservative financial institutions on Earth are buying gold at the fastest pace since the 1960s, that is a signal worth understanding for your own portfolio decisions. Third takeaway, exchange rate volatility is your daily reality now. A multipolar currency world means more swings between currencies. That feeds directly into import costs, inflation, and purchasing power in every country. If prices in your country feel more volatile lately, this is one of the structural reasons why. Fourth takeaway, the geography of opportunity is shifting. Global markets outperformed U.S. stocks by nearly 2-to-1 in 2025. For the first time in a long time, the rest of the world is not just following America's financial lead. And understanding where capital is flowing and why is becoming a critical skill for any investor in 2026. The global financial order built in 1944 is not collapsing, but it is being renegotiated, deal by deal, swap agreement by swap agreement, gold bar by gold bar, and digital payment corridor by digital payment corridor. The changes happening right now in central bank vaults, oil trading rooms, and BRICS summit documents are the early chapters of a financial transition that will define the next 2 or 3 decades of global economics. You are not watching this story from the outside. You are living inside it. If this video gave you a clearer picture of what is actually happening in the world right now, please hit the like button. It genuinely helps this channel reach more people who want real financial analysis. Subscribe so you do not miss our next breakdown, and drop a comment telling us, do you believe the dollar will lose its reserve currency status within the next 20 years? We read every single comment. See you in the next one.